Back, guys. CA final revision lectures are back, and this is the next chapter. You've already seen basic concept, you've seen exempt incomes, PGBP has been done, that humongous chapter revision has been done, and now over to a chapter which is called capital gain. Now, before we start this chapter, let me tell you something that ICAI has told all of us in the initial pages, that we will focus on those transactions or those capital gains that are happening on or after 23rd July 2024. What is ICAI trying to tell us in that? They are trying to tell us that indexation benefit will be very, very limited, only given in certain cases, which I'll tell you, of course, in this video. And they're also telling us that the rates, etc., will be applicable, which are the new rates, which also I will talk about in this one video. Guys, capital gains can be all over the place. That means the chapter can be really big, but to make sense of it, I'm going to give you some really nice shortcuts which you can use to make sure capital gains is done very, very smartly. In the exam, whenever you see a sum on capital gain, go to a rough work and write these 5 details here. You write first sale consideration, then you write expenses on transfer, then you write net sale consideration, then you write cost of acquisition, then you write cost of improvement, and you write long-term capital gain. And now keep filling the blanks so that you are able to answer this question well. Example, if in the exam they're selling shares or they're selling gold or they're selling any asset, then you will put that sale consideration here. Of course, there are some exceptions, like for building, you will compare the stamp duty value, etc. Then if there are any expenses on transfer, you will minus that. Example, let's say the sale consideration is 1 crore rupees. Expenses on transfer is 5 lakhs. So your net sale consideration will become 95 lakh rupees. Then you will look at the cost. Now cost is very, very different. For bonus shares, cost is 0. If you bought a share if you bought some asset before 1/4/2001, then the cost is different. The cost of rights is different. The cost of intangible is different. The cost of something that is gifted to you is different. So you'll find out the cost, and let's say the cost is 40 lakh rupees. Cost of acquisition and the cost of improvement is also 40 lakh rupees. So then your long-term capital gain will be 15 lakh rupees. Now, once you reached here, then the ICAI or Income Tax Act allows you to take some exemptions like Section 54 if you've sold your house and bought another house. So you can take those 54 series exemption. What I mean by 54 series is 54, 54F, 54EC, 54G, all those exemptions you can take. And then whatever is the balance, example, long-term capital gain is still 5 lakh rupees. On that, you have to calculate the tax. So if you go in this manner, it forms as easier answer, and mentally, guys, in your rough work, you can do this and then convert it into fair. Let's see how this is going. As mentioned in the initial pages, the focus will be on transactions on or after 23rd July 2024. The situation before 23rd July has been discussed at the end of this chapter in this book. Anyways, I've discussed the chapter before also, the situations, but now we are looking at those situations which are on or after 23rd July 2024. First, capital gain, is it chargeable to tax? Yes. So there is a charging section, which is section 45, which says that if you have any capital gain, then we will tax it in the year of transfer. We will not wait till you receive the money. Of course, there are some exceptions, but generally, guys, if I have sold my house this year, then I will be taxed this year. Even though I may be receiving the money next year, doesn't matter. I will be taxed in the year of transfer. There is a shortcut called ATPSC. Most of my students know it. If you are not my student, then ATPSC is new to you. Let's talk about what is ATPSC. For capital gain, there has to be an asset. Then for capital gain, there has to be transferred. There has to be a period of holding, long-term, short-term. There has to be a sale consideration, and there has to be a cost. This is basically ATPSC. First, you compute capital gain. Then you will exempt the capital gains, and then you calculate tax. This is what I've explained here as well. Now, first there should be this also we know ATPSC. This is something that we already know. Let's move ahead. What is the definition of assets? We don't need to go in the technical definition. Just that any asset that you see like gold, silver, diamonds, land, shares, house, office, all these are assets. But assets is property of any kind. So they've kept the definition open except SPL. Stock is not asset. Personal movable property, except things that go high in value. Example, my mobile phone is not an asset. My car is not an asset, but the jewelry that if I have, then that is an asset. And artwork is an asset. And last, land, agricultural land, but rural agricultural land is not an asset. Next, transfer. Transfer means you're selling or getting rid of the asset. Example, I'm selling the asset, exchanging the asset, bartering the asset, compulsory acquisition of the asset, extinguishment of an asset, destruction of an asset, gift of an asset. All those are considered as transfer. Next, period of holding. Here comes a big change. If you're holding an asset for more than 2 years, it becomes long-term capital asset. Earlier, it used to be 3 years also. Now it's only 2 years. So if you're holding an asset for more than 2 years, that is 24 months, it will be considered as a long-term capital asset. And if there is some assets like listed Zoom, that's a shortcut, like listed shares, zero coupon bonds, units of UTI, that is a mutual fund, and units of equity oriented mutual fund. Any of these, if you hold for more than 1 year, just more than 1 year, they will be considered as long-term capital asset. Period of holding is important, yes, because unless it's long-term or short-term, how will you use the tax rates? How will you use the exemptions? Next, section 45 tells you that it will be taxed in the year of transfer, irrespective of the sale consideration, but there are some exceptions. First one is section 45(1)(a). What does this mean? That in case my house property gets destroyed and I get insurance money, then the year I get the money, not the year my house got destroyed, that is the year I will be taxed. That is section 45(1)(a). Next, 45(1)(b), taxability of ULIP. Now, what is ULIP? Unit linked insurance plan. Sir, can I explain it in very layman terms? It is a price you pay to get insurance also, and some part of the money is also going to investment. Now it's basically 2-in-1 instrument. Now when you get the money back, is it taxable? Yes, it is taxable, subject to some condition. Let's talk about the condition first. First, the ULIPs have been issued on or after 1/4/2021. Yes, earlier it used to be exempt. Now it's taxable if it's issued on or after 2021, and the premium is up to 2.5 lakh rupees exempt. If it's more than that premium, that means you're paying a lot of premium. Then you get the money back. The money back will be taxable. I'll tell you how. Example, let's say you paid a premium of 3 lakh rupees. You got the money back, which is 10 lakh rupees. What is the difference? 7 lakh. That 7 lakh will go under capital gain. Taxability of ULIP is now covered under capital gain. Next, if you have any stock, if you have any asset and you convert it into stock and then sell it. Example, I have a couple of houses, I make a real estate company and I sell it. My asset is converted into stock and I sold it. Then in that case, that time when it was a capital asset will be considered as capital gain. When it is a stock, it will be taxable under PGBP, but both these will be taxed in the year of sale. Let's take an example. I had a house which was for 1 crore rupees. I converted it into stock and I finally sold the stock for 1.5 crore rupees. Now, this is capital gain till it was an asset. So on this date, fair market value on the date of conversion, you have to see. Just 1 second. All right, so example, let's say there's a flat which I have for 1 crore rupees, I sold it for 1.5, but I converted it into stock and I sold it. Then in that case, till it was an asset, it will be taxed under capital gain. So 1 crore to the fair market value on the day I converted, let's say 1.2 crore, this 20 lakh will be taxed under capital gain and this 30 lakh will be taxed under PGBP. Both will be taxed in the year you sell the asset. Next, section 45(2)(a). What it basically says that if I have some shares in my Demat account, example, I bought some Reliance shares, first for 1,000 rupees, then for 1,100 rupees, and then for 1,500 rupees. And now I'm selling it for 1,800 rupees, only one share. Then which one will go? They say it's FIFO method, so then it will be assumed that this first in has been sold. So you will have to calculate in that basis. Next, section 45(3). If you're a partner and you into a partnership firm or to a AOP BOI, you transferred an asset. Example, I've become a partner in a partnership firm and I transferred my office to the partnership firm. The office is worth 1 crore rupees. Now, when it's transferred to the partnership firm, will there be capital gain? Yes. Then at what value will the capital gain? Whatever price is recorded in the books of accounts of that partnership firm, that will be the sale consideration. Whatever price I bought it at, that will be the cost price, and the balance will be capital gain. Section 45(4) and 49, section 9B have been discussed ahead, guys. Let's talk about section 45(5). Guys, this is basically compulsory acquisition. I have a house, the government wants to buy that house, so the government wants to pay me 4 crores for it, but I want 5 crore. So the government pays me 4 crore rupees. That's called initial compensation. I minus my cost and the resultant amount is capital gain. It will be taxed when I receive the money of 4 crore. What about the 1 crore? I will go to the court, I will hire a lawyer, I will fight for that 1 crore, I get the 1 crore again. That again will be taxable, but now I cannot minus the cost of acquisition because that has already been deducted. So yahan pe I can only minus the litigation cost. And while this amount is received by me late, if I get some interest, that will be taxed under IFOS. And there is a 50% standard deduction for that interest under IFOS. Obviously, we will see it in a chapter called IFOS, which is the next chapter anyways. Next is 45(5)(a). This is basically joint development agreement. Now, what is a joint development agreement? Let me explain. I have a piece of land, I want to develop it, but I don't have the money. So I shake hands with the builder and I tell the builder, listen, let's do it jointly. You build the building, you take my land, and in place of my land, you give me 5 flats in that apartment. Now, in that case, will there be capital gain? Yes, because you're giving away land and you're getting flats. Your land was worth, let's say 10 crore, but the flats are worth 15 crore. Your gain is 5 crore. It will be taxable. But the government says, listen, we'll wait for you to tax it. We will tax it only when you get the flats and you get the OC of those flats or CC of the flats, that is completion certificate. Till then, we will not tax you. And we will also tax you on the date of CC, whatever the stamp duty value, we will take that value of the houses that you are going to get in return. All right, we go to the next one. This is capital gain in case of liquidation of the company. Let's take it from the top. Kingfisher Airlines went into liquidation. I had shares, example of 10 crore rupees of Kingfisher Airlines. Now what happens is they give me an airplane in exchange worth 12 crore rupees in exchange of the shares worth 10 crore rupees. Now, when that exchange happens for the company, there is no capital gain. But for me, I'm getting a plain worth 12 crore and I'm giving up my shares worth 10 crore. So I'm getting a gain of 2 crore rupees. This is the gain under section 46. But hear me out. This 2 crore gain will reduce if the company has profit. And if you remember IFOS, if you don't remember, then we'll go to IFOS and revise it from there. But if you remember IFOS, when a company shuts down, that is closes down, and they distribute assets to the shareholders, that is considered as deemed dividend under section 222C. C for close down. If you remember my shortcut, if you don't, this is deemed dividend. So company shut down, they give money to the shareholders, that is taxable under deemed dividend section 222C. And let's say the company had, but this is only if the company has profits, and the company had profits of, let's say, 20 lakh rupees, then this 20 lakh will be taxed under IFOS. So automatically 2 crore will become 1.8 crore. It will be reduced by 20 lakh and that will be taxed under capital gain. So overall, I'm still being taxed on 2 crore only. Next, buyback of shares. Now, first, let's discuss what is the concept of buyback. I have a share worth 1,000 rupees. The company said I'll buy it back for 1,300 rupees and I will have a sweet gain of 300 rupees. Now, till 1st October 2024, I had nothing to do with this buyback tax. The buyback tax would be paid by the company, but that changed. On or after 1st October 2024, now the government has made a new rule. The entire 1,300 rupees which I will get will be taxable under IFOS as deemed dividend section 222F. Finally, we did a buyback. And what about my cost? That cost, the 1,000 rupees, will be given to you as a deduction, but unfortunately under capital gain as a capital loss. So it will basically be tackled under 2 different heads of income. By the way, in this budget, there is a new amendment on this, but that is not applicable for your exam, so don't worry about that. Next, more about amalgamation and merger. What is amalgamation? What is demerger? You know, guys. Yes, amalgamation and demerger will not be subject to capital gains if all the assets and liabilities immediately before the amalgamation becomes a property of the amalgamated company. Example, Vodafone got amalgamated into Idea. Now, is that capital gain? No. If all the assets and liabilities of Vodafone becomes Idea's. And shareholders holding not less than 3/4 in the value of the shares in the amalgamating company become shareholders of the amalgamated company by virtue of this amalgamation. This is a condition, and in that case, capital gains will not apply. Same thing happens for demerger. If you demerge one unit and transfer it, there are no capital gains. Again, if all the assets and liabilities are transferred, and shareholders holding not less than 3/4 in the value of the shares continue as shareholders in the next company. Guys, while this is capital gain, there are certain transactions which look like transfer, but they're actually not transfers. Example, when your relative gives you something, example, your mother gave a gold chain to you. In that case, of course, you will not be taxed because you're getting a gift from a relative. Even they will not be taxed. So there are certain transfers like that are under section 47. I'll summarize this for you. Assets transferred by HUF to its members. Because here, guys, the intention is not to make money. Assets transferred under a gift, will or inheritance, because your grandfather giving you in assets in will is not to make money. Next, asset transferred by a holding company to its 100% subsidiary, or asset transferred by a subsidiary to its 100% holding company, again parent to son, son to parent. That is not the case of transfer. It will not be considered as capital gain. Asset transferred by amalgamating to amalgamated company. Shares transferred by an amalgamating company. Example, I had shares of Vodafone, now I have shares of Idea. Is there a transfer? It looks like it's a different share, but it's not considered as transfer. Like this, there is a list. I'll tell you the more important one. This is basically sovereign gold bonds. Let's talk about that, sovereign gold bonds, and some amalgamation we'll also talk about. In case of sovereign gold bonds, if you hold a sovereign gold bond for 8 years and then redemption of sovereign gold bonds after 8 years, example, I bought some sovereign gold bonds from the government for 1 lakh rupees. After 8 years, the government paid me 3 lakh rupees. The gain of 2 lakh rupees will not be taxable. That will not be considered as transfer. Next, if I have some bonds and they're converted into shares or vice versa, again, that will not be considered as transfer. Yes. Now, guys, these are the important ones. Let's talk about this. Guys, you had a proprietorship firm, that is a one-person entity, and you converted into a company. Now, a proprietorship firm converted into a company, guys, is the intention to make money. The government says, no, we will not tax it, but provided there are some conditions given in Pack 55. What is Pack 55? The proprietor should become the shareholder in the company. That is P for proprietor. A for all assets and liabilities of the proprietorship firm should be converted into a company. So that is A. Next, C. The proprietor should not receive any consideration other than shares because his intention is not to make money. So then why should you get consideration? Next, 50. That means you should hold, proprietor should hold not less than 50%, and you should at least hold 50% or more of the next company, and that should continue for the next 5 years. That's why it's 55. Pack 55 is the shortcut, and this is when capital gains will not apply. Same thing, now you're converting, but not a proprietorship firm. You're converting a firm, AOP or BI, into a company. Again, same, pack 55. All the partners shall become shareholders. All assets and liabilities to go to the company. These people should not get any other consideration except shares. They should hold at least 50% shareholding, which is to be continued for the next 5 years. And now, guys, what if the reverse happens? What if a private limited company is converted into an LLP? Here, the shortcut is SAC 5565. Let's talk about what is SAC 5565. First, in the private company, whoever are the shareholders should become now partners in this LLP. All the assets and liabilities should be transferred. They should not get any consideration in the partnership firm other than the profit sharing ratio. They should hold at least 50% of the profits, which they should hold for at least 5 years. And the turnover, guys, should not be in the preceding year of this company should not be more than 60 lakh. That means it should be a small company. And the assets in the last 3 years should not be more than 5 crores. So that is 65. Guys, if these conditions are fulfilled, then we'll assume the intention was never to make profit. Guys, remember assets transferred by a holding company to its 100% subsidiary, and then assets transferred by subsidiary to its 100% holding company. Guys, there are some conditions there. We will not consider and will not tax it as capital gain, but guys, this 100% holding should not change in the next 8 years. That means in the next 8 years, it should be 100% holding, and in the next 8 years, guys, this stock should not be sold or should not be converted into stock. That is one condition. And the second one is whoever is sending it to, example, the holding company is sending it to subsidiary company, the subsidiary company should be an Indian company. Next is how do you compute the capital gains? It's very simple. You take the sale consideration minus the expenses. You get net sale consideration minus cost of acquisition minus cost of improvement, and you get the final number. In this case, please do not minus CTT and STT. Don't minus that. What about non-resident? This we will talk about in a chapter called non-resident taxation. What about brokerage, stamp duty, registration fee? That all you can minus. There is no problem with that. Next, cost of asset. Guys, cost of asset, you can read it. It's very simple. Otherwise, bonus shares are free of cost. Any asset before 2001, you take the fair market value or the original cost, whichever is higher. Any asset which is sold on or after 31st Jan 2018, then there is Arun Jaitley cost, AJ cost, which you can read here. I can also discuss it. Any intangible asset which is self-generated, example, I generated a brand of my own, then the cost of acquisition will be zero unless you have purchased that intangible asset. Otherwise, the cost will be considered as zero. So these are some of the things that you can read. Cost of acquisition is a price paid, bonus shares, what is the value, rights shares, whatever you pay for the rights is your cost on rights. If you have any doubts around cost of acquisition, let me know. I have one only peculiar situation to discuss here. Example, I get a house gifted from my grandfather. My grandfather bought the house for 20 lakh. He gifted it to me. Obviously, that gift is not taxable in my hands because I am receiving it from my relative. Now, when I sell this house for 35 lakh rupees, what is my cost? My cost technically is zero because I haven't paid anything. But in this case, my cost will be the cost of the previous owner. That means my grandfather's cost, that is 20 lakh rupees. Same thing, if this same apartment or the house was gifted to me by my neighbor, then that 20 lakh would have been taxed in my hands. And now when I sell it for 35 lakh rupees, then whatever was already taxed in my hand, that will be considered as my cost. Next, section 50AA is very peculiar section. I'll tell you what happens here. There are some assets which even if you hold long term, the government doesn't want to give you the benefit of lower taxation. Guys, long term assets are now taxed, or long term gain is now taxed at only 12.5%, and the government doesn't want to give you that benefit, and hence they say the next three assets that I'm going to talk about, even if you sell them after 1 year, after 2 years, they will be considered as short term capital gain only. The following three assets will always be considered as short term capital asset. The shortcut is MDB. What is MDB? They're all linked to, guys, fixed income instruments. M is specified mutual fund, where 65% of the more is invested not in equity but in debt. So that is a debt mutual fund in reality. Then market linked debentures. Again, they are debentures, and market link means the interest rate depends on the market. And B is bonds. So unlisted bonds. In these three cases, guys, even if you sell it later, guys, it will be considered as short term capital gain. Next, slump sale. There is a company called Britannia. I've used it on Britannia's example, section 50B. Guys, I'm not selling an asset, I'm selling the entire undertaking. When I sell the entire undertaking, that is called slump sale. In that case, what will be my sale consideration? What am I selling it at? Or the stamp duty value, whichever is higher. So we'll take whichever is higher, sorry, fair market value, whichever is higher. So example, I'm selling my undertaking for 1 crore rupees, but the fair market value is 1.2 crore rupees. So you'll take 1.2 crore rupees. Then you will minus expense on transfer. You'll get net sale consideration. You'll minus COA. There is no COI, only cost of acquisition. What is cost of acquisition? It's the net worth. And how do you calculate the net worth of the assets? Any depreciable assets, you have to take that the WDV. Any non-depreciable assets, example, land, etc., you have to take the original cost, excluding revaluation. And all other assets you have to take, you have to consider everything and then find out the net worth. Let's see how this works. In case of slump sale and the entire undertaking is sold, of course, by the way, here guys, it's not 1 year or 2 year. If the asset is held for more than 36 months, that is 3 years. So they forgot to make that 1 year, 2 year change here. So here 3 years still remains. It is called long term, otherwise short term capital asset. And the sale consideration will be whatever you are selling the undertaking for, or the fair market value, whichever is higher. Here the fair market value is considered in 2 parts. The first part here is FMV1 and FMV2. In FMV1, they say that if it's jewelry, artwork, etc., you'll take the fair market value, that means today's value. Shares based on Rule 11 UA, which we will see ahead. Immovable property at stamp duty value. Other assets at book value. This is considered as fair market value 1. And fair market value 2 is basically whatever you're getting. So whatever you're getting is 1 crore versus this 1.2 crore. Whichever is higher will be considered the sale consideration. All right. And in calculating this sale consideration and calculating fair market value, you can also minus liabilities, only real liabilities. You cannot minus any provisions, etc. Cost of acquisition will be the net worth. Just 1 second. All right. And while you're calculating the net worth, this is depreciable assets have to be taken at book value, non-depreciable assets like land, etc. at original cost, goodwill you don't have to take, and liabilities of the undertaking being sold. This is what you need to calculate. This is how you find out your cost of acquisition. All right. Between slump sale and demerger, which is better? Slump sale, there will be capital gain because you have to calculate capital gain. But in demerger, guys, if you fulfill those conditions, that is all assets, liabilities, transfer, etc., there is no capital gain. So it's better to do demerger as compared to a slump sale. Next, deemed sale. Guys, whenever you're selling a land and building, etc., the government says we will compare. There are 4 cases called buds. Whenever you're selling a land or building, or you're selling unlisted shares, or you can't determine the value, or it is slump sale, they will take your value and compare the stamp duty value and take whichever is higher. Example, I'm selling an apartment for 1 crore rupees. The government says good, but I will check the stamp duty value. If that is 1.3 crore rupees, I will take 1.3. Of course, they give you a margin of 10% only in case of land and building. Unlisted shares, whatever price you are saying, they'll compare with fair market value and stuff like this. You have to see deemed sale consideration in certain cases. Next, guys, any advance receipt. Guys, sometimes what happens is when you're selling an asset, people give you an advance, and that advance, guys, you have to adjust against the selling price. Example, I want to sell my house for 1 crore rupees. Someone gave me an advance of 10 lakh rupees, so I have to collect 90 lakh rupees. Now, for some reason, if the advance gets forfeited, example, cancelled, then that amount will directly go to IFOS because obviously it is my income. But if this amount was before 2014, 1/4/2014, before that, then in that case, we don't tax it under IFOS. And how do we tax that 10 lakh? I'll tell you. Then that transaction got cancelled. You got 10 lakh rupees, keep it with you. Next time when you're trying to sell that asset, again, whatever is your cost, example, your cost was 25 lakh. Now you'll reduce it and make it 15 lakh. Why is it being reduced by 10 lakh? Because from the cost of 25 lakh, you've already recovered 10 lakh. So in that case, this is before 2014. This is on or after 2014. Next, exemptions from capital gain. If you are selling an urban agriculture land, but you are not selling, there is compulsory acquisition, then in that case, they will not tax you. It is subject to exemption under section 1037. Next, there are some exemptions here. These are more or less inter exemptions. In section 54, you're selling one house which is long-term capital asset, and you're buying another house within 2 years or constructing within 3 years, you have to keep the money in a capital gain account by June, that is July, October, November return filing due date, and you have to invest the capital gain so that you get this benefit. Section 54B is if you're selling an agricultural land and buying another agricultural land. Section 54F is where selling any other asset except house property. You could be selling land, you could be selling shares, gold, jewelry, diamond, etc., and you're buying a house. So all these cases you get an exemption, but you have to invest ahead within certain period of time. Guys, here and here there is a limit of maximum 10 crore rupees. So this is something that you have to keep in mind. That means I can buy the new house for 12 crore, but the exemption will only be up to 10 crore rupees. And in 54F, we don't have to invest the capital gain, we have to invest the net sale consideration. What is the difference? If I get the money after minusing expenses, what is that amount? That is the net sale consideration. That is what I need to invest. So basically 54F tells me to invest a little higher. And these new assets have to be kept for 3 years at least. If you sell it within 3 years, then whatever gain was exempted will be taxed again indirectly. Next, section 54D, there is a compulsory acquisition of your industrial undertaking. 54EC is easy capital gain. 54G is Gaon. What is this? This is new at CA final. This you're shifting an industrial undertaking from an urban area like Bangalore, Mumbai to a rural area. In that case, whatever the transfer expenses plus the new investment that you made will be minus. So whatever your gain is, you can invest it ahead within a particular period of time, that is 3 years, and take an exemption, that is 54G. There is 54GA also. Here you are going from an industrial urban area to a SEZ. So it is go awesome. So you are moving to an urban area, not to a village, but to an SEZ. Same like 54G. 54H says, hold on. Basically, you need to say that the government says that, listen, in case of compulsory acquisition, if the government has acquired a property, then you need to calculate it only after you've received the money. And 55A, what does this mean? If you are saying that I have sold my asset for X amount of money, but the income tax officer does not agree, or if he feels that the difference between what you are saying and the actual value is more than 15%, then he may refer the valuation to a valuation officer. Assessing officer may make, it's not compulsory, reference to a valuation officer if the value of the asset as claimed by the assessee based on the estimate made by a registered valuer is at variance with its fair market value, if he feels it's at variance, or is of the opinion that the fair market value of the asset is more than 15% or more than 25%. If there is a difference of this much amount, then he may refer it to the valuation officer. Now, what are the special rates of tax? Let's talk about any asset like gold, jewelry, etc., whatever you sell, land, etc. If it's short term, there is no special rates, it is normal rates. But if it's long term, then it will be taxed at 12.5% only. If it's shares and if it's long term, then up to 1,25,000 they will not tax, above that 12.5. That means, guys, if it's long term, then 12.5% is a number. And if it's short term, then 20% is a number. Guys, this is 111A, 112A. This is for listed instruments, and this is other than listed instruments, any long term capital gain. All right, moving ahead, cost in certain cases, you can read it. This is the AJ cost. This is when you are selling an asset, some listed assets on or after 31st March, January 2018. Let me explain. Guys, you bought a share for 1,000 rupees in the year 2016, and that time the government had made a rule that if you hold it long term, it will be exempt. You're selling in the year 2024 or 2025 now for, let's say, 2,200 rupees, and you feel it is exempt, but no, the government had made a change on 31st January 2018. They had made a change that now it will be taxable. So because of this change, now it is taxable, but because of that, the government gives you a new cost. How do you find out the new cost? Are two steps here. The first step is this, cost is original cost or new cost, whichever is higher. And what is the new cost? Is the fair market value on this day or the selling price, whichever is lower. So you can revise this. This is again a CNP concept. We discussed this. We used to call it AJ cost there. Next, if you're selling shares, will it be PGBP or capital gain? So capital gain, if held for more than 1 year, that means you're generally investing and it will be treated as capital gain. Once this is decided, then it should be capital gain only. And if PGBP, if you're buying and selling a lot of shares every day, then you can decide that it is PGBP and you can tax it under PGBP. Next, guys, concept of indexation. Guys, is indexation there, not there? Yes, it is there, but only in certain cases. I'll tell you first. Are you an individual or HUF? Yes. Are you selling a land and building like a house, property, office, etc.? Yes. And did you buy this property before 31st July 2024 and selling it after, before 23rd July 2024 and selling it on or after 23rd July 2024? If that case, you will calculate the capital gain without indexation. That's right. But when you're paying tax, you have two options. You will, on that amount without indexation, you can pay only 12.5%. That is one option. Or you can take Hyundai i20. What is i20? You can index it and pay 20% tax. So the gain is always without indexation. But when you're taxing it, there are two options. And if that i20 leads to a loss, then it will be considered as zero. All right. Now over to the case laws here. There is Jupiter Capital. There are a few case laws, I think 5 or 7 case laws. Let's see what are the case laws. It's been about 29 minutes. We've been revising capital gain. In 5 more minutes, it will be done. Alright, so let's start. This is the first one, Jupiter Capital Private Limited 2025 का case law है. This is very important. Whether reduction in share capital by a company without any change in the shareholding pattern and face value of the shares constitutes a transfer. Yes. Guys, what they're trying to do is they're reducing your share capital and they're paying you money. In that case, are you getting some money? Yes. So it will be considered as transfer. Yes. Held that reduction in share capital results in transfer under the provision of the Income Tax Act, as there is extinguishment of rights causing your shares. That means your rights are reducing and you're getting money in return of that. So this will be considered as a transfer. This is Jupiter Capital Private Limited. This could be a good case law. If the assets are held for many years, the shares, then it will be long-term capital gain, otherwise short-term capital gain. Sheshaisi Steels Private Limited. This is a 2020 case laws. Now in this case, what they are saying is that you have enabled someone to enjoy the immobile property. Can it be considered as a transfer? Of course, that is only transfer. If I give my house to you, I let you enjoy that house as an owner, then it will be considered as transfer. Yes. Balakrishnan versus Union of India and others. Here, you wanted a higher compensation. Guys, let me explain this case to you. Balakrishna had some property which the government wanted, so it was compulsory acquisition. Then he started bargaining with the government. The government said, okay, I'll give you a higher price. Does that bargaining change it into a normal sale, or is it still compulsory acquisition? It is still compulsory acquisition. Next, Dempo. Very interesting case law. An asset was held for more than 2 years. That is it long-term capital asset? Yes, but it was a depreciable asset. So if you remember PGBP, guys, if you sell a depreciable asset, then it is always the gain is considered a short-term capital gain. Now, when he sold this asset, he wanted to invest in bonds and save that money under Section 54 EC. But 54 EC says that what you can invest is only long-term capital asset. So depreciable asset sale, will it be considered long-term or short-term? They say that the gain is short-term. So whatever calculated in the gain, it will be short term, but actually asset is long term, no, because held for more than 2 years. So you can take 54 EC benefit. This is great for Dempo. Next, fiber boats. Guys, you've given some advance for purchase of land, building, etc. Can that purchase also be considered as an investment ahead? Yes. Aditya Kumar Jajodia. What he did is he bought some land, he had a house property or whatever some property he had, and he paid some money to get the title name clear in his name. That is considered as cost of improvement. Yes, of course. Manjula Shah, the classic case law. In this case, there was an asset which was gifted. Example, my father gifted me an asset and I sold that asset. Now indexation I will get from the date I got it or from the date my father got the asset. They say from the date my father got the asset, I will get indexation. But of course now indexation benefit is reduced. So this case law also loses a lot of importance. Next, Shakti Metal Depot. Would depreciable asset forming part of block of assets on when depreciation is being allowed since an acquisition changes character if it's not used for business purpose? Yes. If it's forming part of block of assets, then it will not cease to be a part of block of assets so long as the SSC continue to business. Not very important case law. Next, Syed Ali. Guys, you're selling an asset and you're buying another asset but in joint names, or you're buying two properties and they are together. Example, I'm selling one house and buying two houses which are together. Will it be considered as one house? Yes, but nowadays this case law also loses importance because you can sell one house and buy up to two houses together under Section 54 if your long-term capital gain when you sell the asset is up to 2 crore rupees. Gurnam Singh, guys, he sold a land and he bought another land, but this land, the next one is in son's name. Is it okay? Yes, as long as you invest the money, it's okay in whoever's name you are investing in. Next, Kamal Vahal, he invested the next house and he bought the next house in his wife's name. Can he still take the exemption under Section 54F? Yes, he can. Ravinder Kumar Arora, again, guys, here he invested, he bought the new asset in joint names. Can he still take the benefit under Section 54? Yes, he can. Sambadam Uday Kumar, big name. I'll tell you what happened here. Here he had to invest and he had to construct a house within 3 years under Section 54F. If you remember, he completed the house, but some things were remaining. It's okay. It doesn't matter as long as the house overall is complete. You get an OCCC. You can take the benefit under Section 54F. Hindustan Unilever, here as 54 EC, you need to purchase the next bonds within 6 months. They paid the money within 6 months, but the bonds were allotted to them after 6 months. Is 54 EC still allowed? Yes, it is allowable. Next, Gujarat State Fertilizers Chemicals, again not very important. Would sale of fertilizer bond as loss be treated as business loss or loss under the head capital gain? It is to be treated as a business loss because, guys, they were basically subsidy would have been treated as a business income, so it is connected to their business and hence it will be considered as a business loss. So this is my chapter capital gain. We discussed the concept, we discussed the case laws. You can now go over to the question, and the more the questions you do, the better it gets. If you have any doubts, reach out to me on the tax doubt solving group that you may be already a part of. If not, let me know. All these documents are attached in the links. You have the app, download the app. log in and you will get access to the folders where you can access all these QuickBooks and more. Watch out for the next video. All the best, guys.